It's hard to believe that we're already more than halfway through 2021, and you may be wondering which recent investment trends may affect your money in the second half of the year. Today, we're going to look at some important things that I'm seeing in both the economy and the stock market, and we'll consider some ideas for positioning your money going forward. But before we do that, I'm thrilled about all the exciting new things happening here at Grinkmeyer Leonard Financial. Specifically, our focus on continuing to strategically manage our clients' investments and offer financial planning strategies that can help people just like you maximize your money, your time, and your relationships. We want to help you invest smarter, make confident decisions, and retire with options. So please reach out to our team if we can help you do just that. Now, the first half of 2021 showed stellar gains for the S&P 500, and the S&P 500 is widely regarded as one of the best ways to gauge how 500 of the largest companies here in the United States are doing. So this chart specifically is a 2-year look at the S&P 500, and you can see the continued steady recovery post-March 2020 lows. So if anybody is questioning the strength of the recovery, this chart provides some evidence that the positive trend is still very much intact. And as of the date of this chart, which I pulled this on July 9th, you can still see periods of ups and downs. So despite that, we really don't see any signs of a major breakdown at this point because the recent push higher since, say, mid-June shows some pretty convincing momentum. Now, this chart looks drastically different because as you'll notice, it kind of looks opposite. It's declining. And we refer to this as the fear index or the VIX. So this chart attempts to project the market's overall expectations for volatility over the next 30 days. And it can signal the level of risk or the level of fear or even stress in the market. And so this index doesn't actually predict where the market's going, but for me, it's often one of many things that I like to look at and that I like to monitor to show potential cracks in the market as a whole. And again, I pulled this chart on July 9th, and you're going to notice that the VIX is trading at the same level that we saw prior to the pandemic before fear climbed to unprecedented levels last March. So what might we take away from this chart? Now, we can see that the market is definitely volatile based off of the pattern that we see where you see frequent spikes. But when you look at the volatility across all the major investment asset classes, the trend still seems to be trending downward, which is a good sign for markets in the short run. Now, this can change very quickly. So you've got to watch the VIX very closely. And of course, our team monitors that here on behalf of our clients. Now, if you look at the headline media and headline news, there's a lot of talk about rising interest rates and about inflation moving higher. And so I wanted to touch on that for just a minute. One of the most important things that we've seen recently is China released their inflation data last week, which told us that prices in China are up 8.8% between June 2020 and June of this year. So many of the products that we as Americans purchase, of course, come from China. And that leads us to assume that prices will continue to increase here in the United States, at least in the near term, because our prices tend to follow China's lead. Now, if you've watched previous videos of mine, you've heard me saying for months now that, the US dollar is falling. We've been talking a lot about inflation, and ultimately the US dollar is worth less than it has been over the past 3 years. So you and I simply can't buy as much with our dollars that we could before. And the Fed is likely to continue to flood the system with dollars over the next few years. Now, we do now know, since my last video in June, that they plan to begin backing off as soon as later this year. And we can expect at least 2 interest rate hikes by 2023. So our team believes that inflation is likely to remain higher between now and this time next year. Now let's look at what's happening across the rest of the world. We do know that the global recovery is broadening, particularly in Europe, where they're catching up to our growth here in the United States. We've seen growth slow in China, just in general. And of course, their demographics are worth watching because they have so many people and so much economic activity in China. And of course, the COVID Delta variant is worth watching because we know another shutdown could obviously affect our economy and the world around us. But ultimately, the vaccines continue to show much progress. And I think a lot of other countries are going to open with a fair amount of confidence going forward. Now, I do want to take a look at the workforce and some worries that I see pertaining to workers that may not re-enter the workforce. Now, this chart shows the unemployment rate, and you can see, of course, it declined rapidly after the pandemic, and then lately the unemployment rate is slowly declining. So what I want to point out is when you take a look at active workers, so active workers can be defined as those people who are employed, or maybe they're actively looking for work. That's where I have some concerns. So this next chart shows us that we are still down about 3.3 million workers since the beginning of 2020. I have read studies that estimate about 1.5 million workers actually retired earlier than normal because of the pandemic. And of course, signs are not pointing that they might re-enter the workforce. They're now retired, and it's hard to reverse that trend. So we have to focus on the remaining workers that haven't come back because extended unemployment benefits have encouraged them in some cases to stay home. Now, when I record my August video next month, we should know more about this because many states have now ended federal benefits, and the data should start coming in to tell us whether these folks will come back to work or not. So that's something that's definitely important to watch. Now, I want to address for just a minute how you should be positioning your money going forward. Now, I always say focus on risk management first. You never want to take more risk than you're comfortable with. Think about asset classes that historically provide a hedge against rising inflation, because I think those will continue to be important, although they can be volatile, so you've got to understand your risks. And I'm talking to my clients a lot about the fact that conservative investments are becoming harder and harder to find. It used to be that interest rates were high enough that you could earn a decent amount of money on savings accounts or on money market funds. And today, that's not the case. Now, as interest rates tick higher over the next few years, of course, those accounts should pay more interest. But ultimately, conservative investors who have consistently relied on the bond market for conservative returns, it's becoming harder and harder to find places to go. And a lot of times we see volatility in the bond market itself. We are dealing with a lot that we've got to watch, and the Federal Reserve is a very important piece of that equation. So we're watching them closely. From a stock perspective, I think international equities may present opportunities, particularly in certain pockets of the world. You've got to be very strategic about that. But I do think there's opportunities there. And I also encourage you to consider your time horizon. So if you're a day trader, you should have a totally different investment strategy. That's someone that may be looking 12 to 24 months out. And if you're only looking 1 to 2 years out, your investment strategy is going to be very different from someone that's focused on the long term. I like to tell my clients that just because you're going to retire one day, that doesn't mean you're going to pull all of your money out in day one of retirement. Hopefully you're going to live another 20 to 30 years. And so having a long-term focus is very important. I also want to encourage you to prepare your mind for increased volatility. I think it's going to be a bumpy ride between now and the end of the year. And you need to stay disciplined, and you need to work with your financial advisor to avoid making emotional decisions. So if this is something we can help you with, of course, we are more than happy to do so. So that's all I have for you today, but I do want to encourage you to subscribe to my channel if you want to see more regular videos and content from our team. And also, if you'd like to schedule a time to talk more specifically about your own situation, a link to my calendar is below, so click on that, and I would love the opportunity to connect with you. Otherwise, I will see you in August. Thank you for watching this video. The material in this video has no specific regard to your own personal investment objectives, financial situation, or your needs. This video is provided for informational purposes only, and we encourage you to speak directly with a qualified financial advisor before investing. Please pause this video for more details concerning investment risks and other important considerations.